Hello everyone, I am Chitrak Datta and welcome to my channel. Now, before I start the CIP lectures, I would like to request you all to go through the Macmillan books and then watch this as a revision. You can only watch this video, but reading the Macmillan books will be more beneficial to you. Now, without further ado, let's start Module C Credit Management of ABM. This is Unit 17 and Lecture 1. Now, in this lecture, we are going to talk about the importance of credit, the historical background of credit, principles of credit, the types of borrowers we have, and the types of credit we provide. Now, what do we mean by credit? Credit is nothing but loans. So the loans we take from bank are called credit, and credit is what drives our national economy. It gives opportunity to entrepreneurs to undertake large project. Now suppose an entrepreneur wants to start something, but he or she doesn't have the capital for it. So what he or she can do is take loan from banks and start the project that he or she wants to. Then the people can purchase or create assets by taking loans, and then can repay the same loan by generating earnings in future by using the assets, right? Now, consumers like us wants to buy things beyond our income. So what we do is that we take loans or credits and spend on items that normally which cannot spend. So that drives our demand and increases the production of such products. For example, many of the people right now take credit to buy iPhones or gaming consoles or cars, etc. And as a result, the manufacturing companies increases their production for the demand, right? So that is what this is meant by. Now, adequate and cheap credit drives the economy for higher growth, right? So when the credit is available, people will take more of it, and that will in turn increase the production of the products, because people are going to buy more things regularly, and the companies will produce more, and it will help the economy to grow. Now, we should also consider that excessive credit availability for non-productive purpose, for example, buying goods, puts inflationary pressure due to time lag between increase in demand and creation of supply. That means that suppose credit is available in cheap and people are buying more iPhones, right? So what it will do is that it will increase the demand for iPhones, and the manufacturing company as a result will not be able to supply the demand in time. So as a result, the prices of iPhone will rise. Now this happens with every single thing during inflation, right? Now right now our country is going through an inflationary phase, and you can see the rise in the costs of things, right? So this is just like that. But what does our RBI do? RBI controls the inflation by using bank rate or CRR or SLR, and they balance the growth and inflation using this. You must have heard about all these things during JIB, and if not, I will discuss about these in future lectures, or you can just Google it up. Now let's discuss about the historical background of credit. Earlier, what used to happen is that private money lenders played important role for credit requirements, right, which caused the problems in rural areas, and it increased the rural indebtedness and rural landless population. So people used to take money from private money lenders in a higher interest rate, which they were unable to pay, and as a result, the money lenders used to take up their land, and they become landless. Now, the nationalization of banks, which happened in 1969, was a watershed event. Okay, because before that, people used to take money from private money lenders, but after nationalization, focus on giving credit on low interest rate to rural people was given priorities, and as a result, the people of rural background was helped in many ways. Okay, so also before the nationalization, credit flow was mostly to big businesses. Okay, but after nationalization, what happened? The concept of priority sector became an integral part of banking, and as a result, RBI ensured that credit flow to this sector. Now, the principles of credit. What do you mean by that is uh, suppose you are working in a bank and you have to give credit to a customer, right? So there are some unwritten principles that you have to follow for proper disbursement of the loan. What are the principles? First of all, the safety of funds. You have to make sure that the person is not a criminal or a terrorist, or and the money that he is taking is used for proper reasons, right? So the funds are safe, they are not used for any cheat kind of things. Second, the purpose. Suppose someone comes and tells you that they want to take an education loan, so the money has to be used for education purpose only. They cannot make house or start business with that money. Then profitability. If a businessman is taking a loan, you have to see that the business is a profitable one, because unless the business is profitable, they cannot pay the loan in time. Then liquidity of the business. There must be some proper cash flow in the business, because if there is no cash flow, there is no guarantee that the loan will be repaid. Then security. One must make sure that the loan is properly secured by security money, or by some other ways. You have to make sure that the loan that you are giving is properly secured. Then the risk spread, like the loan that you are giving is balanced out, and we have to make sure that the EMI that the person is giving is not beyond his income, right? So that has to be made. Now, there are different types of borrowers who avail the credit facilities from banks, and each of these borrowers fall under some act through which they are maintained, right? So for example, if someone is an individual and an individual takes loan, he will fall under the Indian Contract Act 1872. If a sole proprietary firm takes a loan, he will that firm will fall under Shop and Established Act. A Hindu undivided family will fall under Hindu Succession Act 1932. Any companies, be it a one-person company, public company, private company, will fall under Companies Act 2013. Partnership firm will fall under India Partnership Act 1932. Limited liability partnership will form under Limited Liability Partnership Act 2008. A statutory corporation will fall under Statutory Corporation Act. Trust or REITs will fall under Indian Trust Act 1882, and cooperative societies will fall under Cooperative Societies Act or Multi-State Cooperative Societies Act 2002. The local authorities or institutions and government departments will fall under the respective acts, and joint venture through SPV will also fall under the respective. Now we'll talk about types of credit. Credit are divided basically on two types: fund based and non fund based. Fund based means the money is transferred directly after opening the loan, and in non fund based no transfer of money is done, but commitment by bank on behalf of the client is given, which can lead to future transfer of money. For example, any bank guarantee or letter of credits or co-acceptance of bills or forward contracts or derivatives. These are all examples of non-fund based credit. Now, the fund based credit can be divided based on period. It can be for short term or long term, which are called term loans. Also, it can be based on purpose, like for working capital finance or fixed asset finance, export finance or crop loan. It can also be based on customers, like for corporates, MSMEs, retail, agriculture, international or institutional. And lastly, it can be divided during by currency. The loan can be of rupee or foreign currency, right? So that's it for the lecture 1. We will discuss the lecture 2 in the next video. Thank you.